Hi, everyone, and welcome to Macro and Global Liquidity Analysis, Gold, Silver, and Bitcoin monthly update for April 2024. We're putting this presentation together for our valued clients of the Ainslie Group, including Ainslie Bullion, Ainslie Crypto, and the Gold and Silver Standard. I'd like to start today by welcoming our panel. We've got Joe and Paul. How are you going today, guys?
Very good. Thanks, Chris.
Good, thanks. Great to be back again, mate.
Yeah, great to have you back. Now, we've been doing this for a few months now. We're starting to get in the groove of how this all works. So we'll just start off with a disclaimer and then we'll dive straight into it. Firstly, just remember before we begin with our analysis that everything we say and show in this presentation is intended for general informational purposes, does not take into account your particular circumstances, objectives, or situation, is not financial advice, and you should always do your own research and consider obtaining independent advice before making any investment decisions. All right, so the process that we follow, that we have been following for these last few months, is we start off with that big picture global macro cycle overview. Then we narrow into where we are in the global liquidity cycle, because we have this belief that the global liquidity cycle is what drives the global macro cycle, and we'll prove that hopefully through this presentation. We'll then go and look at our macro assets, specifically gold, silver, the gold-silver ratio on Bitcoin, because they're the ones that we like to focus in on. And then to end up, we've got a bit of a trading plan that takes advantage of those cycles that we'll share with you how we're going with that. So let's start off with that very big picture, as we do each time, where we are currently in the global macro cycle. And we do that through this chart. Now, this chart says March. That's because we've got the data coming later this week that will update it for April. But as it stands, this is where we sit. Joe, I'll start off with you. Can you start us with a bit of an overview of where we are in this cycle, what this cycle's showing, just really getting us up to speed on what you're seeing happening in that aspect of the market?
So we spoke about this last month. Obviously, we've got the four different cycles. Bust, which if everyone sort of thinks back to the end of 2022, is where the markets were at their lowest. But leading into the bust, obviously, we had quite a strong market and then speculation into the late cycle. At the obviously once the bust is completed, that's usually around the bust period is the best time to be buying risk financial assets. We've transitioned into early and mid cycle. Obviously, we'll wait for next week's data. I suspect they'll be going back into mid cycle. An extra point that I'll touch on that I didn't really talk about last month was, if you think about liquidity leading markets and markets leading the economy, so around that mid cycle and late cycle, everything seems really quite rosy with the economy. And then the markets usually go bust, and that's when we sort of usually figure out that we're in a recession. The recession's always backward looking. And once we're in that recession, that's when you'll usually see policymakers bring the liquidity back in. So the liquidity comes in, which feeds the markets, which feeds back into the economy, which is why we're now seeing that stronger, the economy start to pick up again.
And what's different about this, from my perspective, and I'll get your take on this as well, Paul, I think we have seen a sort of sideways early to mid cycle play out during this last several months, because we haven't had that, what you were just referring to, Joe, pull back into recession. We just haven't had that really negative set of data or news or situations that have forced the liquidity to come flooding back in. Is it a little bit different this time, do you think, Paul? Because like we are used to having that recession that really flushes everything out, or at least a lot of fear, those big crashes in the stock market that just haven't happened.
Yeah, I mean, we've had analysts talking about this mythical recession for quite a period now, right? So and it doesn't seem to be coming out, and that could be across a number of factors, and we've got to remember just how unprecedented COVID was in terms of the amount of money that was spun into the system and where it went in particular. So it's a confusing setup. We've got, and I think today's news, we talked about the fourth longest inverted yield curve. Now the inverted yield curve is supposedly 100% track record of calling a recession. We're into 511 days of it so far, and but we've had recession type play outs in terms of share markets coming off and that sort of thing. But the true recession of negative GDP quarters has just not played out in the traditional sense. So it's quite confusing for markets, I think.
And that leads us to, let's look at the US. And I know we make this point every time. The US isn't the world. The globe is much, much larger than the US data, but the US data gives us a place to start and a place to look to really dig into the weeds on what's actually going on. And when we look at growth, we have seen a long period of time where this ISM, the blue line, was under 50. It was a very long period of time where it was under 50, which should have been a recession, or potentially was a recession just in disguise. I don't know how you want to talk about or look at that, Joe, but we've gone through that period of time. It now looks like from our leading indicator that we're heading back up and out of that. Does that sort of feed on from what Paul's saying? Very confusing.
Yeah, well, historically speaking, spending that much time in terms of contraction, the ISM you would get those 2 consecutive quarters of negative GDP, which would signal the recession. That hasn't happened, which also, we talked about the mid-cycle and early cycle in the previous slide, how it sort of flattened out a little bit. That's general, and this chart explains that as well, where policymakers haven't had to really throw a lot of gas on the fire to get the economy going again, because the economy is going so well. Well, it's actually turning up, and it's starting to do well again without that extra liquidity.
And this just throws that 3-month leading indicator on there that pushes out even further, and it really does look like we've broken through. Paul, is there anything more there that you've sort of gained? Because that really doesn't paint a picture that we're heading back down. You would argue that after being so long in that negative territory, we really should be seeing growth coming out of the US going forward.
Yeah, and let's not forget the fiscal response as well. So we've had the US government spending hand over fist. That's going to move things along. So I think this fixation on rates, so we've seen elevated rates, and that should be playing out in recession. At the same time as the rates have been elevated, the liquidity, and we'll see charts later that remind us the liquidity's been pumping, right? So that is definitely inflating the markets, and as Joey said before, that leads the economy. So I see it will continue up because, and again, not to spoil all alert, but we have seen it come off, and it's but still the momentum's on its side.
I think that leads us into the other factor of this, because we look at growth, but then we also need to look at inflation, and inflation is just what everyone seems to be talking about. You get lots of analysis saying that higher for longer is a thing. You've got other analysis, sort of the contrarian analysis that we've been looking at, and certainly from our leading indicator, suggesting that inflation is maybe being even overreported currently compared to the real data. What's going on in this chart, Joe, and how does this relate to the conversation we're just having about growth?
Well, first of all, I'll just point out, you've done a great job with compiling this inflation data. It's quite interesting that the reported data was lower than the actual what we perceive to be the actual inflation data when you're looking through mid 2022. So, but now it's sort of it's kind of reversed, where the reported data is now higher than what we actually think it is. So in the short to mid term, we may see a bit of a bottoming out process, and it might start to tick up a little bit potentially, especially when you've got a growing economy, since we know we are moving back into expansion in terms of the ISM and where we are mid-cycle. I don't think we get that 1970s second wave of inflation that everyone's been talking about, just generally speaking, because of reasons like demographics and technology, which are all deflationary. So going forward, I think it might be a little bit of a bumpy bottoming out process, but I don't see it ticking up into that second wave like a lot of analysis is talking about.
And Paul, how do you look at that? Because you're obviously looking at the world through the lens of bullion often, and we know people tend to think of bullion as a inflation hedge. That's why a lot of people come into store. They're wanting to do something that's going to protect their debasement of their currency and their underlying purchasing power. How do you think about this chart?
What the chart might be telling us is we've got a new norm, so that they might secretly be happy with this circa 3% inflation, where traditionally the target for the Fed and most central banks is this arbitrary 2%. And we've got to look at that in a couple of different ways, I think. So inflation, so yes, gold is traditionally an inflation hedge, but as we've said before in this very program, that's more of a monetary inflation hedge. So here we really are talking about CPI. We're talking about that basket of goods. But we also have to always remember, because this is behind most of what we're talking today sits a few $100 trillion of debt in the world.
Yes.
Okay, and that is driving most of the behaviours that we talk to. Now, there's only a few ways to get rid of debt, and that's to pay it off, and that's clearly laughable in terms of our current deficit trend, or you inflate it away. Okay, and so an extra % on that amount of debt is very, very sizable. So part of this could be just a sneaky little readjustment of what that base inflation rate is, because the third option is to essentially forgive it or a jubilee, or the GFC type response of just make the cost of it zero by having zero rates. So there's a few things in this chart that we've just got to watch, because it could signal a new norm or a new accepted norm.
And it's so fascinating that you say that, when looking at these two lines where they are right now, where we've got the current sort of real-time data telling us we're right around that 2% mark, and the official numbers telling us that we're right on that 3% mark. It'll be very interesting to see how that plays out. If we do just see we may see these lines just hovering. We don't know, but we may see them hovering around and establishing a base there, which would absolutely, to your point, be a new normal. So I'd like to lead from there into the other part that you're talking about, which is that government debt. And these are charts we spend a bit of time analysing ourselves and discussing in quite a bit of depth each month. This idea that we've got just extraordinary and ever-growing US government debt, and the backdrop of what's starting to become a little bit scary down here. Much easier to see when I zoom in. So that view, was over the last 30 years, and you're just looking at the different rates down the side. So these are the yields that you get on government bonds, against the red line there being the Fed funds rate. And we can see them spiking up, but if we zoom in and look over the last 5 years, you can see we're really starting to get some momentum there again, back up towards those highs. Paul, I might start with you on this one, because I know it's something you've been looking at. What is this picture telling us? Because I'm starting to get a little bit concerned, and I've been talking about this for quite a while in various formats, that if this does break above where we were previously, we're entering into really quite dangerous territory, where it's going to force a response from the US, really, because they can't justify rates, or not rates, yields being too high when they need to finance all of this debt that needs to be rolled over.
Yeah, absolutely. And again, to remind viewers that rising yields means a lower bond price, and what we are seeing quite often now is bond auctions falling short. So there's just not the demand to buy this new debt. Now, part of that is people allocating in different places, but from an investor point of view, but from a sovereign point of view, from a global point of view, is where we're clearly seeing, and we've seen it for some time, is an aversion to US bonds, or an increasing aversion to US bond by sovereign players. Now, that's played out in a couple of ways. We've seen continued year after year record purchases of gold by sovereign states, where they're electing to hold their reserves in gold rather than US treasuries. So that plays out. That's a big part of the market. So that's playing out. And so so that inevitably sees that rise, and you're seeing the factors behind that are just getting reinforced pretty unprecedentedly this week, where the US has announced that they're going to transfer seized Russian assets to Ukraine. So that's it's one. We've had the weaponization of the US dollar in response to Ukraine. This takes it to a whole other level, and so I think I recounted on the program last time, when we'd spoken to some guys very senior in the analyst space, based in Singapore, when Singapore was one of the biggest buyers of gold in that period, and saying, well, even geopolitically, neutral, safe Singapore is looking at this situation going, you know what, we might hold gold instead of US Treasuries because we just can't get caught up in some unilateral application of weaponization by the US of that Treasury market. So that's all playing out with higher yields. In short, it literally is just supply and demand. So the demand's dropping, and the price of bonds goes down and the yields goes up. So, but as you say, it's getting very, up is not good when you have $34 trillion of debt.
Absolutely. Joe, I know you have had a long sort of standing view that the US dollar is, that we use that analogy, the cleanest dirty shirt in the laundry, that people, the US dollar is not going anywhere. And I'm not suggesting that it is, even from what Paul's just said then about this new weaponization, we'll call it, continued weaponization of the US dollar and seizing assets and all of those things. How do you view the potential risk here if we do see these yields spiking? Do you think that we have the potential for it to become unruly and people really start rapidly shunning the US dollar? How do you view it?
I think there's always that possibility that, you start to see those rates rising. What I will say is that at a certain point, rates are high enough that people will buy them. Like, that might not be the 5% or 6%, but if you start getting 7, 8, 9%, people will start buying bonds unless there's something fundamentally wrong with the accounting on the US Treasury side and the fiscal position, which, is possible, I suppose. But going forward, what I will say as well is that they have a lot of tricks up their sleeves. So when you're talking about the US Treasury have actually started doing I suppose what they'd call a test in issuing short-dated bills to buy long-dated bonds to strengthen up demand at the long end of the curve. So that would help stabilize the bond market.
But isn't that effectively just monetization of debt?
That's exactly right. So that's why, we'll come back to this later on, but that's why owning assets is super important, because when they're monetizing debt, that's pushing money into the system, and that money overflows into other assets, right? So, and then you also look at stuff like the statutory liquidity ratio, which they've been talking about, which is effectively the collateral that banks need to, but the minimum percentage of deposits that commercial banks have to hold on their balance sheet. So if they're looking at lowering that ratio, that allows the banks to come in and start participating more in those bond auctions to purchase government bonds. So the bonds would be on the bank's balance sheets, which is also direct monetization as well, because the banks would be creating money out of thin air like they usually do.
I just want to go back slightly on what you just said a little bit earlier in the piece that you just talked about then. When you say getting out of control, you could argue that we're already at that point where this is absolutely out of control. Can it spiral where if it breaks above here, it's a self-fulfilling doom loop sort of prophecy? I mean, you tend to be more on the conservative side. I tend to be more on the concern side of this. Where's your level that you would start to switch over to being more concerned?
I don't know where that level is in terms of a nominal percentage. Like you said, I'm more on the conservative side, and I think there's still a lot of cards that they can pull out to tame whatever interest rate rises in the bond market throw at them. They all end up in monetization.
Yep.
And like I said, in that scenario, regardless, you want to own hard assets, and you certainly don't want to be owning the bonds. I'm just saying that they're potentially going to squash whatever issue in the bond market arises if it starts to really get out of hand. I don't know, maybe that's 5.5%, 6% that starts to happen. A lot of people are calling for 5% yields. I don't know exactly where that is. It also depends at the degree of how quickly that moves as well. If it happens very quickly, of course, that is going to induce a quicker response. If it happens quite slowly, who knows? They might just let it go for a little bit. Depending on where inflation and that is as well.
Yeah,
that 5.5's critical. What none of us have talked about is the red line.
Yes.
The red line's in the wrong spot. Okay, so the fixation on the Fed dropping rates has real meaning when we look at that chart as well, because on no planet should that be above the bond yields for a healthy market. So that's the other thing at play, is that it forces the Fed's hand to drop rates to try and rein this in a little.
And that's such a good point that people don't understand, that really when they say, well, they won't lower rates because we've got the risk that that will push inflation higher, there's other mechanics at play here where really the rate should not be this high. And that's a really important piece that people don't understand. Joe, I also really do accept your argument there that we've got to look at it rationally, right? Like we do have to go, there are a lot of other cards that can be played. So it's easy to be concerned about, well, what happens if it breaks higher, and that spiral concern. But we haven't seen them pull out all the ammunition yet, and they're certainly not going to go quietly in trying to bring that under control. So I think that's a fair point.
Yeah. And like Paul said, in terms of inflating the debt away, if they decide to pull out a few of those cards and really suppress yields while letting the economy run a little bit hot, that's the best way to basically inflate the debt away by running negative real rates. So who knows? But once again, leads to monetization of someone has to buy those bonds. The money has to be printed out of somewhere, and that usually ends up in bonds first, then into other hard assets.
Well, that gives us a perfect transition into the global liquidity cycle, because we believe ultimately that's what drives asset prices, and we'll talk about that directly. So if we start off just with this big overview, I always leave the text in here as well to just emphasize certainly how cross-border capital looks at global liquidity. Joe, do you want to just give us a quick update or overview of why we're looking at these different categories that make up the total global liquidity number compared to what other people talk about?
Yeah, so that red line's pointing at about $171 trillion worth of global liquidity. The reason why we follow cross-border capital closely is because we don't just look at the world central bank money, which is that black line down the bottom there, which is only I believe about 12%. Oh yeah, that's what it's saying there, about 12%.
Yeah,
so
yeah.
A lot of people are very focused on those balance sheets of central banks for tracking liquidity, and that can be quite volatile and misleading at times. So when you're looking at like the shadow monetary base and the world collateral pool on top of central bank liquidity, that's what gives you a more accurate reading, and that's what we follow closely to determine where we're heading in terms of asset prices.
Absolutely, and I think it really highlights that point. And Paul, you've talked about this before as well, the multiplier effect that matters from that collateral or the bonds. It is really important, isn't it, that when the bond market starts to become unstable, it can really throw this liquidity out.
Yeah, absolutely. It's just the more volatile those markets are, or acting out of character, the more they're discounted in terms of their collateral nature. So it's just like the how good an asset is in terms of how much you can borrow from a bank. It's the same with bonds.
And that becomes really important, because other people, and not everyone, but a lot of other people, when they measure it and just look at the central bank balance sheet, they're missing a big part of the picture, and a big part is that volatility. Just why we also look at it. I brought this chart up and talked about it for a number of months now, that really we can see a very strong correlation between global liquidity and world financial asset prices. It's undeniable when you actually do the back tests and you look at the correlation coefficients with this stuff. So it's not just us saying it. You can statistically prove that global liquidity is tied very closely to world financial asset prices. And this chart, which Joe, I might just get you to throw over to you on this, we've seen very consistently asset price booms occur when we're towards the upper end of the global liquidity cycle, and banking crises occur towards the bottom. Do you want to specifically focus on why we see those banking crises at the bottom of the cycle?
Yeah, so back to March last year, where we had the banking crisis, the regional banking crisis, it was due to a lack of liquidity in the system based on the value of the bonds, which were their assets, versus their liabilities, which were their cash balances. So we know that a lot of a lot of those cash balances were being withdrawn to the larger banks, the too big to fail banks, which left the asset liability balance on those regional banks with a lot more liabilities than they did assets, generally speaking, because their bonds worth a lot less. So what happened was the Fed came in and provided liquidity in the form of being able to redeem those bonds directly for cash, which stabilized the system. That's why liquidity is so important to the banking system, to balance out those liabilities against the assets.
And that's an extremely important point I'd like to dig a little bit deeper on. You can't have the system collapse due to lack of liquidity. So often people are focused on when they're analyzing these markets, they're focused on the interest rates or what they think the Fed's going to do next. But when push comes to shove, we've never seen a situation. I think, Paul, you could probably talk about this a little bit, but we've never seen a situation where they won't step in when the liquidity becomes too tight. And I would argue we're approaching that period now. Would you agree with that?
Yeah, and it's in the chart, right? So history says every time it gets to that point, they have no choice, because this chart probably starts, if I was to guess, in 1973-ish, when we left the gold standard and we're in a purely credit-based market. It just has to. It's a Ponzi scheme, so it just has to keep injecting that liquidity to pay for the ever increasing amount of debt, or the servicing of that ever increasing amount of debt.
And we've got this chart, which does go back to that 70s to sort of highlight your point. This isn't a new pattern. I think this is the whole point of this chart, is to just highlight that we've been over and over and over through these cycles. It just happens over and over again. It's becoming more exaggerated, which you could argue is because we're seeing more exaggerated policy responses simply because they have to. Joe, what's your thoughts on that?
Yeah, I agree with that. Like the chart states, it's 5 to 6 year cycles, and that's based on currently $350 trillion worth of global debt. So that would equal out to be about $70 trillion need to be refinanced every year. So to refinance that debt, you need to have what they call balance sheet capacity, which gives you the ability to inject liquidity back into the system. But also, because the debt's so growing, we do get those large gyrations in that wave, with tops and bottoms as the central banks try to manage the economy.
And we can see that we always love this heat map because it shows it in sort of more of a visual form in real time of what's happening. But we've gone through that period where we've had a lot of liquidity injected into the system. And on the back of COVID, we've gone through that period where they've tried to pull a lot of liquidity out of the system through quantitative tightening efforts. We've got all the different countries listed down the side, and each individual sort of color indicating where they are. We would argue we're going back into a period now where there's more liquidity coming back into the system again. So quite consistent. What I wanted to focus on specifically, however, is our measure of weekly global liquidity, because this is giving us somewhat different view from what we've seen on that liquidity index, where we've seen that index sort of pulling back, but this doesn't really look like it's pulling back. Can you explain why that would be, Joe?
Yeah, so the index is just that. It's an index based on rate of change, whereas this is a nominal amount of actual liquidity in the system. So you can we had the lows back in the low in the markets, which coincided quite closely with the low in October 2022. Also, as the liquidity expands, it doesn't expand at the same rate all the time. We've had, like I said, you've had that slight pullback in the index, and even though it doesn't show a large pullback here, it's sort of leveling out. It goes to show the importance of liquidity in the markets and their effect on the market, which goes back to a couple of slides back where you're talking about the relationship between liquidity and financial markets. It's liquidity leading markets, not the other way around.
And absolutely, and I can see it being particularly interesting that we haven't had a dip in the nominal amount, so in the dollar amount of global liquidity, yet we have had in the index. That's saying to me that we are going to need a whole lot more of these dollars. So I would imagine we're going to see this weekly chart continue marching higher, because when we actually start to see some serious injections of liquidity coming back into the system, we're going to see much bigger numbers. So that's quite scary in itself when you're throwing around numbers like total global liquidity of 170 trillion and 70 trillion of debt that needs to be refinanced in a year, like very, very large numbers.
And it makes sense that chart will continue to go up as well. So when you think about the amount of debt that needs to be refinanced, and you need balance sheet liquidity capacity to actually do that. So whilst we're going through a current a bit of a pullback at the moment, liquidity doesn't move up in a straight line. And like you said, we'd expect to see this nominal amount, this absolute amount of liquidity in global liquidity move a lot higher over the next 12 months.
We'd like to talk about this chart as well, just to remind people that there's two different types of inflation. Paul, do you want to sort of step us through this?
Yeah, referred to it earlier. So that dotted line right down the bottom is US CPI, which is what everyone's fixated on, and whereas what few people fully appreciate is the solid black line, which is the global liquidity. So that's in simple terms, just ever increasingly created new money. And when you overlay the gold line of crypto and gold against that, that's where you get the true appreciation of the inflation, the monetary inflation that these hard assets that can't simply be created out of thin air provide against that backdrop. So, and again, we've discussed each month, but it's just really, really important to remember. You can almost overlay directly a chart of the top 1% richest and the bottom 50, and they almost align with each of that black and dotted black line. Because the week to week pay earners that whose wage goes up by CPI, but so does the basket of goods, are stuck down there. It's the people that get onto these hard assets and can actually keep up with the monetary inflation that really get the benefit.
Such an important point, and people who want to get ahead cannot get ahead by keeping up with the inflation, with the consumer price inflation, because that just keeps you static. You're just treading water if you're down here. You need some form of asset that can outperform that, which is the perfect segue to talking about the macro assets that we discuss here. The reason we call them macro assets is because they're assets that keep up with that macro cycle, gold, silver, Bitcoin, the GSR. Let's dig into each of them and have a bit of a look. I've adjusted this chart slightly from what we've seen last month to make it a little bit clearer. And this is the bigger picture view where we can look over sort of the last decade and see that there has been quite strong correlations between the lows in global liquidity and the highs in global liquidity and the lows and the highs in the gold cycle. Particularly interesting when we zoom in and look at the situation currently, just to point out this line average gold price for the month. So this April chart's using up to the end of March's data, and the average price of gold for that month was heading up. But what I find really interesting about this chart is we've seen that going up against the backdrop of the Global Liquidity Index having that little bit of an air pocket or a little bit of a pullback. Paul, how do you see that? I mean, you're looking at gold every day, talking to people about it. What's driving this little anomaly that we've seen in the gold price over the last month or so?
Yeah, sure. So if we just move to the near center of that and you go back to this time 2 years ago, gold was following the Global Liquidity Index down, and then along came Ukraine. So that fear trade, the war trade, pumped gold up to those new highs, despite the falling liquidity. That did reverse as people, frankly, grew bored of that, and it wasn't affecting them directly. Then we've seen, I guess, the same, where we have seen the liquidity index come off, but we've seen gold go to, and that's stopping at sort of 2180. It went to 2400. And that's really around those heightened geopolitical risks around Iran and Israel and whatnot. So gold, and arguably too, an escalation of, we talk about the each way bet that gold presents at the moment. So whilst liquidity is coming off, we then get heightened concerns around a share market crash, and we saw the S&P 500 come off fairly heavily. So gold was the uncorrelated asset that people went to in that play as well. So that's the beauty of gold, is it has that each way bet in these sorts of times.
And it's so great that we've watched two of them now unfold in real time, where that was the anomaly, and we've seen it again, perfectly aligned with what's going on geopolitically and in the stock market. So lined up absolutely perfectly. 2 from 2. The difference between here, what we saw back when the liquidity cycle was still falling and where we are currently, however, is I would be fully expecting this liquidity index to pick up and head back up into the end of the cycle. So there's probably a lot more tailwinds behind gold this time around than there was at the Ukraine
Yeah, and a lot more solid base, right? So as
Yes.
your Ukraine demonstrated, people are fickle. So last night gold came off quite heavily, as did silver, because apparently everything's cool. Like nothing happening in the Middle East. Move along. So that fickle nature will see those short-term blips, and so you got to zoom out a bit. Whilst that looked like a big off, from gold had gone up 20% this year. It's now up 17. So it's a relatively small blip, but those blips are going to happen on narrative type things. The more structural things like global liquidity have a lot more solid base.
And that makes so much sense. And that's really the basis of our framework and why we look at it through this lens. Joe, I know you love talking about silver. So I'll bring this for you to have a little bit of a look at here. But we've got the same thing, that sort of longer term silver following very similarly to gold. What's the difference here? Why have we not seen, in your view, but we've certainly seen a correlation happening to the global liquidity cycle. We've seen those lows line up, but silver hasn't broken those highs. Is it because we're looking at, well, and it still is pointing up when this is pointing down, but is it because silver's been looked at through a different lens? How do you view silver?
Yeah, so I think it's fair to say that gold's seen more as the monetary metal, and silver's transitions its way more to a commodity industrial use. The way I'm looking at silver at the moment is as we transition through our cycles, we've gone from early into mid cycle, and we're looking at the ISM and it's starting to show economic strength. During times of economic strength, you actually need those base metals to build out infrastructure, whether it be copper, iron, or silver, all those sorts of things. So I think we're about to start transitioning into a period where not only is liquidity going to continue to rise, but also the actual demand for the underlying metal is going to globally is going to pick up with the business cycle as well.
I absolutely agree with that. And I think that aligns with where we think we are in that mid-cycle, where you tend to have, to your point exactly, we tend to have this demand actually pick up for the industrial use. Paul, I'd like to explore that a little bit further with you, specifically looking at silver through the gold-silver ratio. So it's a little bit different when you look at it on the chart, as you would expect it to be, because we sort of have these really short periods from between the high and the top of the GSR cycle and the low of the GSR cycle. If we look at where we are currently, 90 is an historically high number. How do you interpret this chart against the backdrop of what Joe just said, where you've got the industrial use of the metal, but also the catch-up play for the monetary use of the metal that tends to come after big moves in gold?
Yeah, and so look, absolutely, silver's outperforming gold this year. It's even after last night, it's still up around 24% for the year. Now that's off 30%, so it's had a pretty decent off last night. But that's all to do with, I think, that arrow down the bottom there. And for context, so yes, we were around 90. It got to 83, and now it's back up to 85. They're still high numbers. Okay, so the real moves are when we see reversions down to 40, 30, 20. So the real action is typically later in the cycle. We're still, when we go back to that very first slide, we're still pretty early on in the cycle. So it's a bit early to think that silver's really going to do the big moves that it does late cycle. And then to Joey's point, we've got a real move in commodities, and that's half of silver's play. So it's half monetary, half commodity, and that is a global rebound. But then there's talks about China in the process of buying up and stockpiling commodities so that they can devalue the yuan, because that's getting real pressure at the moment. So there's a number of factors at play that could be pushing silver, supporting it to the extent that it is a little bit earlier than you'd probably expect.
Silver will always be frustrating like that, because you need to be in the trade when it happens, but you never really get that strong indication of when the move is going to happen. But I do agree with you that we would expect the big move to come later in the cycle. We're not quite there yet. So
yeah,
probably,
but to your point, we're in that cycle, right? So silver's hardly going to probably lag from here. So, you know, the old saying, you're better off being a year too early than a day too late. Well, it may be 6 months, but it's a pretty good play at this point, I think.
Well, and that industrial side of it is an argument in and of itself. So it's not like you're not being rewarded while you wait, because we're still expecting that support to be there. We then, of course, turn our attention to Bitcoin. We've had a long history of looking at the correlation. I think, Joe, what were the numbers? Was it sort of, if you compared it to gold in terms of correlation to global liquidity?
Oh yeah, so in terms of global liquidity expansion, you've got gold at about 1 point for every 1% in expansion liquidity, you get about 1.5 percent movement in the price of gold. Whereas with Bitcoin or crypto, we'll specifically focus on Bitcoin. For every percentage point of global expansion in liquidity, you get about a 5% move in Bitcoin. Oh, sorry, a 5 times move in Bitcoin.
So that really does align with this idea of exponential gold in that regard, because you do get that higher move, but with the higher volatility, you get the downside of volatility as well. Like it's not a you know, only up scenario, is it?
Yeah, you can't have one without the other. So we're actually going through that period at the moment. When we flick over to the next chart, where we're talking about the pullback in Bitcoin versus global liquidity, that small pullback that we've currently had. So yeah, that chart explains it as well. So currently, if we had a Bitcoin price overlaid with that liquidity chart, we would see that around the same time we've had that pullback in global liquidity, at approximately the same time pullback in Bitcoin, just because it's very sensitive to liquidity conditions as well.
So it's a perfect asset to trade when we're looking at liquidity, but you have to be aware of the volatility. Obviously, this chart where we zoom in has really caught my attention this month, because as we expected, we actually talked about it last month, that we were going to see a big move up, because remembering this is the average price of the metal of Bitcoin for the month, and it really has taken off against the backdrop of that global liquidity pulling back. Is this the same story as what we saw with gold? I mean, I can't imagine it is.
Well, they're trading a little bit differently at the moment, you know, and gold's sort of been a bit of an outlier with its strength and performance due to what Paul was saying in terms of geopolitical events. On the other side of the spectrum here, we've had that huge run up from January, the end of January into the end of March, you know, probably or most likely fed by speculation and the ETF inflows. Since then, we've had quite a bit of outflows from the ETF. You know, that's likely due to liquidity sensitivity of the asset as well. So if we actually had, say that was a daily chart with a candlestick, you would see that the arrow wouldn't be pointing directly up. It would be more in line with what our liquidity chart is telling us, with that little bit of a pullback.
So if I was to summarize that, though, in terms of what Paul was saying versus what you're saying with gold, so you've got gold having that sort of counter move on the basis of geopolitical issues, and it's serving its role as a truly uncorrelated asset. Bitcoin, in this case, that move wasn't really because of the same reasons. It was because of those fundamental reasons around Bitcoin itself. Is that how you would frame it?
Yeah, 100%. So Bitcoin hasn't, I would argue, has not, in terms of geopolitical events, cemented itself as an asset that you would generally want to own. We're not quite there yet. We know that all those events generally lead to money printing, which is liquidity positive and is going to be price positive for Bitcoin in the mid to long term. But in terms of in that moment, remembering we've had those huge dumps on the weekend when those geopolitical events came out, and there was no other markets trading. Bitcoin was probably the only market you could really trade. So, but in terms of acting exactly like it's still trading like a risk asset at this point.
And you can't necessarily assume that it will long-term respond, which is what you were saying really, but that it will long-term respond negatively to those things, because it may end up being like a gold, but at this particular juncture in its history, where it's the only asset that was trading on the weekend, it responded that way. But yeah, to make that assumption that we'll always do that, I think would be a bit bold and probably a bit reckless.
Yeah, 100%. And things change. The market's always changing. So how the markets can perceive Bitcoin in the next 10 years might be completely different to how it perceived it in the last couple of weeks.
Just a little side note, I saw a headline today that they're looking at potentially making US markets or floating the idea of US markets being 24/7. So you think about, being able to trade the S&P and things like that across a 24/7 timeline, like what you can currently do with crypto. It'd be a whole different market entirely in that environment because we can't automatically assume what would happen. It'd be crazy times, I think.
Yeah, for sure.
This monthly macro and global liquidity analysis is brought to you by the Ainslie Group, Australia's trusted choice to buy gold, silver, platinum, and crypto online or in our Brisbane and Melbourne showrooms. With over 50 years of operation, we're your reliable partner in wealth management. If you're looking to buy tokenized gold or silver anywhere in the world, check out the Gold and Silver Standard for the security of real-world precious metals combined with the flexibility of blockchain. Okay, so we've looked at Bitcoin. Now we move on to our plan. We have a little trading plan that we like to provide to everyone. Pretty straightforward. The idea is you buy low, sell high. So we use the Global Liquidity Index to determine where we are in the cycle, and towards the start of that cycle, we establish a buy position. We hold that position right through until we get a sell signal towards the end of that cycle. And this is the chart. Our buy signal was back on the 10th of January 2023. The global liquidity cycle low was in October 2022. Obviously, you don't know that the low's in place immediately. It takes a little bit of time to establish and be confident that that low's in. We were quite confident it was in at that point. And we've been doing very well since. We've got the data here from that entry at 17,179. We're now sitting at about 66 or nearly 67,000. So 289% over that period of time, which annualized is 225%. So fantastic numbers. Any particular comments that either of you would like to make on the Bitcoin chart as it looks at the moment?
I'll just say that we're going through that current choppy style period at the moment. This is Bob Lucas' work, obviously, where he's got his 60-day cycle where he expects a potential bottom, which may or may not be lower than that low at 60,000. He expects that bottom around mid to late May, so around the 20th, I think he was quoting. So that doesn't necessarily mean, like I said, that we break lower than 60,000. It might just mean that we chop around for a bit longer. My perspective, as always, is if we know we're in a bull market, which I believe we are, based on our liquidity indicators, any dips are a buying opportunity, in my opinion.
Fully agree with that, and I really do like these indicators, the Bob Lucas indicators, really to identify opportunities if you still have capital to deploy and you didn't get in at that just beautiful entry that we did back in January 23. You look for opportunities where you're towards the low of the cycle, because if you know you're coming to the end of the 60-day cycle, so maybe it's around that May period, that's where you can look to get back in. But I suppose, to your point, Joe, you might be chasing this up because the low might already be in.
That's right. Yeah, you don't want to be chasing it. If you know you're in a bull market, why chase it?
Completely agree. Well, that's sort of stepped us through everything we wanted to talk about today in terms of our framework, looking at the big picture, getting into the weeds, and then looking specifically at the assets. So to wrap up, have you got any sort of final thoughts or comments that you'd like to make? Paul, we'll start with you.
No, I think that last chart just reminds us of that correlation with liquidity index, right? So we have seen it come off. There's very good reasons for that. But there's also very compelling reasons why it will be short-lived. So I think it's all very reinforcing.
Joe?
I said the same thing last month regarding, whether it be Bitcoin, gold, or silver. The next 12 to 18 months are looking quite good in terms of price appreciation. So in terms of holding those assets at this point in time, with everything that's going on macro-wise, I'm quite happy with how it's projecting to pan out over the next year or so.
Yeah, my thoughts on that, I agree. I find this period, the sort of boring sideways period, can be a little bit taxing on you mentally, because you're going, it goes up a bit and then down. That choppiness can really throw you off if you're not a seasoned used to it. But out of this, I expect we will see fireworks again. We will see the exciting moves higher. So we just have to bide our time and wait, I suppose. But it's looking exciting for the second half of the year. So until then, we just keep paying attention for any sort of anomalies that pop up and keep our eye on the prize, which is that longer term cycle, which is playing out so far, in my opinion, perfectly. So
and Chris, I think people have got to just take away just a few numbers from today. Joey talked about $70 trillion,
yes.
right, each year on that $300 trillion of debt. So it can't stop.
No.
Okay. There'll be little narratives along the way and hiccups and whatnot, but at the end of the day, that amount of refinancing takes a lot of money. It's got to keep coming, and the correlation that we keep seeing with gold and Bitcoin is proven. So it's pretty compelling. Don't worry about the short-term noise. Look at the bigger picture.
Yep. Zoom out always.
Agree.
Yep.
100%.
Well, thanks everyone for watching our update for the month, and thanks to Joe and Paul for their contributions to the analysis today. I always value feedback and discussion, so follow me on X at Tipper Analytics to stay up to date or to reach out. We'll be back in May with the next monthly update to reassess and identify what has changed. Until we chat again, good luck in the markets.
See you guys.